student. Assalamu alaikum. I'm Tanzia Afrin, lecturer Finance and Banking Department, Milestone College. Today my topics is Chapter 5, Capital Budgeting, Class 9 and 10. What is capital budgeting? First, I assume that a company wants to purchase fixed assets, machine, equipment, building, or maybe land. Then it have to analyze or process 3 or 4 or more than project. A company wants to purchase a machine that's a generator. So at first it has to analyze in market 2 or 3 brand or company. Somewhere the price of the machine is more, but warranty is less, and somewhere warranty is high, but price of the machine is low. So the financial manager have to take a good decision which company will be good for his company, because there is so many advantages, disadvantages, merits, demerits, and must be this is for long time. It's 5 or more than 5 years above, and this is for long time. So we can call it that when a company purchases fixed asset to make a financial plan for a long time is called capital budgeting. Capital budgeting is an analysis process. This already I told you, it's analyzing activities. Always from financial manager have to analyze different company, different project, or different price, the incomes from them, and the year. All these are include of capital budgeting. So what kind of process it is? It is a evaluation process. Always financial manager have to evaluate, and when a company use it, when company purchase fixed asset for a long time, then the financial manager use capital budgeting process. Application of capital budgeting. Next topics, that when company use or apply this capital budgeting. First one, when purchase fixed asset, purchasing fixed asset. Company when purchase fixed assets, already I told that equipment, building, land, machineries, then company have to make a financial planning for a long time, and then capital budgeting is used. It is necessary because by doing capital budgeting we can get different types of mathematical or financial statement, like income before tax and depreciation, then the net profit of from that equipment. This is fixed asset purchasing, and in this case company use capital budgeting. Next is expansion of business. Here you can see business expansion with the intention to increase the production capacity. So a company when wants to expand its business area, then it need to purchase land or building or different types of machineries. That time it have to make a capital budgeting. That I say different types of machines have to purchase from different places, and that's all are for long time, and capital budgeting have to do. Next is new product launch. New product launch says when a company already had a product like a juice, mango juice, or orange juice, but company wants to launch a new product like apple juice. So for launching this new product, company already have to analyze the market, that the people even like apple juice or not. In our country, in Bangladesh, most of we didn't like apple juice in our country. So apple juice will not be a profitable project. All these I have to analyze previously. This is also including with capital budgeting, that the taste of the general people, and then the company have to invest in new product, or launching new any new flavor or design or anything. Last one is modernization or replacement. Nowadays maximum company wants to modernize or replace new things, like in anywhere new technology or automation. Like in our college milestone in class, there is so many CC camera. All these are the innovation or the modernization and replacement of our organization, like that. Just like this, different types of business has a plan to modernize or replace its business, and to do this, company have to sometimes purchase assets, maybe movable assets, maybe fixed assets, or buildings, a new technology have to purchase. In this case, capital budgeting is very necessary. Now, the importance of capital budgeting. Number one, profit oriented. All of we, the financial manager of a company or a company CEO, do the capital budgeting to make profit. And this is the main objective, main motive of a company, of any company, that profit oriented. To make a good profit or a big volume of profit, every company wants to do anything, and capital budgeting is one of them. By doing capital budgeting, a financial manager can find out the present value. Then through this present value, it can find out the average rate of return, payback period, or all others to NPV, IRR. That all are I will tell you in later. So the first one, the importance of capital budgeting is profit oriented. All of are we doing for make a good profit for a business. We won't get any kind of loss or any kind of harm. So we do capital budgeting. All are assumption that we will do in future. We assume in previously or present. Second is size of investment. How the size of investment, the volume of investment is very important, because big investment there is a big risk, or low investment there is a low risk. Yes, the size of investment is very important, and according to the size of investment, the company have to earn the profit. The size of the profit will be important part of capital budgeting. So investment size or volume of investment is very important for capital budgeting. And number 3 is risk oriented. Future is always uncertain. Already in chapter 4 I already told you that risk, there is always a risk in business, and uncertainty also. So in capital budgeting, same thing. Risk is here, and we have to consider the risks in our every step or every process to find out the method or technique. Then the topics is in our book. Process. What are the process of capital budgeting? Number 1, expected cash flow. Expected cash flow is the main thing of any company, that the business organization, each and every business organization are selling anything, maybe it's goods or maybe service, both, and by doing this it have to earn a cash. That's may call sale revenue also, because by selling anything we can, or a company first can earn amount. After deducting so many expenditure, we get net profit, but first step is expected cash flow, that's sales revenue. Sales revenue is very important for a capital budgeting, so it's a main process. Without expected cash flow or sale, a company can't face or can't see any kind of profit, net profit, and the other cash in hand is very tough to find out. Number 2, discounting rate. Although already I said capital budgeting is a long-term process, maybe it's 5 years or for 6 years. So when I invest today and we'll get the cash inflow after 1 year, 2 year, 3 year, 4 year and 5 year. So all the cash flow I have to discount it and make it in a present value. This is my first and foremost duties or activities as a financial manager. Because at the end of 5 year, at the end of 6 year, when we collect or when we earn an amount, I have to discount it by a rate. This is called discounting rate, and make all the cash inflows at present value, because I invest the volume of investment in today, in the date of 0 period, that's mean today or first year. So all the cash flows I have to convert in present value. Then I can compare that I face profit or loss. If the investment is bigger amount and all the earnings is less than investment, then I face loss. But when the investment is less amount and the all earnings are more than the investment after discounting, then I face profit, and the company will face the net profit also. And net profit means the from sale different types of cost, depreciations, tax already deducted. This is a process. And then last one is capital budgeting technique, selection and application. Capital budgeting has different types technique, and financial manager have to select or application select it. There are mainly 4 types of method. One is ARR, PBP, NPV and IRR. I will show you all these things in board. There are 4 types of technique already I said. First one, ARR, average rate of return. All these are capital return or accounting rate of return, both in your book. Accounting rate of return. Number 2, PBP, payback period, pay. And number 3, NPV, net present value. And last one, IRR, internal rate of return. Rate of return. All these are the technique or the method of capital budgeting, and in your book the first 2 are there, and number 3 and 4 are not in your book. First 2 methods are ARR and PBP, are traditional method. Traditional. It means it's not latest. For the first ARR and second PBP, PBP's techniques are shown in your book. and the left 3 and 4 are not shown in your book, technical or the math. Today, ARR and PEP, I'm telling you traditional method. I already said traditional method means it's not latest. Nowadays, the use of ARR and PEP is becoming low because it's not considered discounting rate, time value of money, and the cash flows, and also the risk also. Because in ARR, what is ARR and what is PEP? ARR is when the average net profit is dividing by the average investment. That's called ARR. So in this case, it not consider any type of discounting rate, time value of money, and the risk also. That's why it is considered as a traditional method. And second, also PEP, payback period. It is depend on all the cash flows and how long the investment will back to the company, the number of the year. That's called PBP, payback period. Here also no time value of money or discounted rate or the risk is considered. So the both ARR and PEP are considered as traditional method. And next, NPV and IRR. NPV, net present value. That's in this case the discounting rate and the time value of money is considered. So it is considered as non-traditional. It means the latest, non-traditional. It means latest technology, and this is the best technique or method in capital budgeting. Here all the cash flows are discounted and compared with the investment. And last one is IRR. It is internal rate of return. By doing this IRR, a company can analyze or compare or can take a good decision to it will invest or not. These are the all techniques of capital budgeting. Here, ARR. The formula of ARR is average net profit divided by average investment multiplying 100, and the average net profit total net profit divided by number of year. How can we get all this information from the question or a stem? We get all this information, and I will show you later. Next, average investment. Investment divided by plus salvage value divided by 2. This is the formula of ARR. Average net profit divided by average investment multiply 100. How can we get average investment? Average investment equals to total net profit. I will get it by analysis or make some math and get the net profit. I'll show you later, and divided by number of year. Average investment plus salvage value already given in question or on a step, and divided by 2. This is the 2 is the formula. Capital budgeting and find out the average rate of return. Capital budgeting, we have to remember a format, and I write this format in the board. Just look at here. First one is sale and number of year 1, year 2, year 3. This is a model, but this is the format for you to understand or remember. First one is sale, then minus current cost. What is current cost? When the cost is changed with the per unit, this is called current cost, minus fixed cost. All those costs which is not depend on the unit change, always is fixed. There are different types of fixed costs like machines, then rent of office, salaries. All these are not depend on the unit productions. So this is called fixed cost. Then sale minus fixed cost and minus current cost and fixed cost. This level is called income before tax and depreciation. Other name or cash flow before tax. Now minus depreciation. From this level I have to deduct depreciation. In the question or a stem there is depreciation, and is there is no depreciation, we have to find out, and there is a formula also to find out depreciation. This level is called income before tax. Plus tax, we have to pay it to government. In our country, naturally 40% tax, but it already given to the question. Income before tax minus tax, income after tax, or net profit. This is the level net profit, and it is used in ARR. Already I already show you that average net profit. All these are the average net profit. First year, second year, third year, all are added and then divided by the number of year. How many year? That's the number of year. This is the level of ARR used for ARR, average rate of return. And then payback period is how long the investment will back to the company. The period of the time, the recovery time, is called payback period. And how we get the after tax cash flow? Add depreciation. This depreciation again add with the net profit and get also here salvage value, if there is salvage value, otherwise no use of salvage value. Salvage value, and that will add only the last year. Here third year, first year, second year, and third year, add only third year with third year. This is the salvage values used, and I will get after adding after tax cash inflow or cash flow. Same word, cash inflow, and this is used for PBP. PBP, payback period. This is the format, all format. Maybe from sale, then let's come to income before tax and depreciation. This is the base. Then income before tax, net profit, and after tax cash flow. These are the level, and from anywhere the math may become, and you have to do after that. This is all the format, full format to find out average rate of return or PBP.